All right, you're most welcome to this class. This is Management Decision and Control with your tutor Samuel Livanda. And today we basically want to learn more about decision making under conditions of risk and uncertainty. Okay. Now, as you may know that this paper is basically Management Decision and Control. So we have looked at different scenarios, especially where we have some element of certainty, and also different models. So today we want to interest ourselves, how do we make decisions in times of risk and uncertainty? Okay. Yeah, no, so as you may see, we have two terms there. We have the term of risk, and then we have the term of uncertainty. Okay. Now, just so you know that the two terms are actually different, and how the two are different is that risk basically means that there are several possible outcomes, and these are unknown in advance along with related probability. Okay, so you have some element of predictability, okay, of what might actually occur. Okay, so and that is why we have things to do with the probability of occurrence, which can be, of course, statistically calculated, and then we can also be able to determine the frequency. Okay. Now, when it comes to uncertainty, uncertainty is just the opposite. For it means that we don't know in advance the potential outcomes of the decision. Okay. And it means that that would also mean that we also don't have even the probability measures. We basically can't tell in terms of probability what will happen and what may not happen. Okay, so you can know, and that's why you see insurance companies are there to give you a cover on your risk. Okay, and the way they determine in terms of your premium, in terms of how much you should pay, is based on the probability and the likelihood of whatever you're insuring yourself on is likely to occur. Okay. But when it comes to uncertainty, because everyone doesn't know exactly what will happen, no one will definitely insure you on aspects of uncertainty. Okay. Yeah. So you basically need to know the two differences. So uncertainty, you basically don't know what the potential outcomes of a decision could be, and then you also can't tell the associated probability. Okay. Yeah. So with that in mind, it's also, of course, very good to also understand that risk could occur because at the planning stage, we usually make certain assumptions. Okay, we make assumptions that may not really turn out to be true, and just this is based on the circumstances and the environments that we work in. Okay, if this is business, we understand that business does not work in a vacuum, but business works in environments with different factors, okay, that might happen. Okay, so it's very important. So we have a scenario here. One of the examples of saying an example of risk situation is one in which, say, there is 70% of probability that returns from a project will be in excess of 100,000. Okay, but a 30% possibility with returns less than 100,000. Now, as you can see that since we've said that when it comes to risk, we have some element of probability of a certain occurrence of a certain scenario. You're saying that if it is 70% that our returns will exceed 100,000, then the other balance of the probability is 30%. You must also know that probability adds to 1 or adds to 100%. Okay, if it's we speak about in terms of percentages, then you know that probability is up to will run from 0 to 100%. Okay, but in even the 100% is 1 because it's 100 over 100. So ideally, take it that probability is from 0 to 1. Okay, and if the probability that somebody may, let's say, may die is 20%, it means that the probability that they'll survive is just 100 minus 20%. Okay, maybe to be 80%. So you basically need to understand the dynamics of probabilities, even as we get into down to understand more how we can make decisions in areas of risk and uncertainty. Okay. Yeah. So that is just so you can understand. We also have a scenario here, okay? We have a soft drink dealer knows that his sales on a given day are dependent on the weather conditions. On a hot day, the sales are high, and on a cold day, the sales will be low. If he anticipates a hot day, then he will prepare lots of drinks for sale. And if he anticipates a cold day, he will prepare a few drinks for a sale, because his drinks are determined by what? By weather. Now, however, the actual outcome could actually be a cold or a hot day, and this means that he might not achieve some of his anticipated sales. Okay, best if, for example, he prepared for a hot day and it turns out to be a cold day, it means that he will actually lose. If he prepares for a cold day and it turns out to be a hot day, the same thing. Okay, but if plans for a cold day and it actually appears to be a cold day, then it means that he'll be able to meet his sales. Okay, so that's the same thing that we should be able to understand when it comes to risk. So there's the possibilities are there. There are several possibilities, and we also have some relative area of probability, okay, that we can easily attach this to. Okay, so the fact that we've appreciated that risk also comes with probabilities, us is also to understand what is probability distribution and how does it work with expected values. Okay, what's the probability distribution and how does this work with expected values? Now, basically a probability distribution, okay, probability distribution basically shows you the alternative courses of action. Okay, it basically shows the alternative courses of action for management, as well as indicating the degree, okay, the degree of uncertainty that may exist on each of the alternative courses of action. Okay, so it basically shows you an outcome with its respective probability. Okay, and just for you, so you know that these probabilities are based on the circumstances that will really happen. Okay, based on the level of uncertainty that might happen. So we have also maybe also just so you know, probabilities, like I indicated, probabilities, of course, they exist based on maybe evaluation of what has happened in the previous, okay, decisions on determining probability. It could also be statistical, okay, statistical in nature, in a way that if at all, for example, you'd consider, for example, tossing a coin. When you toss a coin, there's 0.5 probability that you actually get a head or a tail. Okay, so and these are some probabilities that can be determined by doing something over and over time. Okay, but so you know that given that we have probabilities, also understanding that the total of your probability should be basically 1. Okay, probabilities range from 0 to 1. Like I said, they are only percentages. If at all, maybe you're looking at maybe 20%. You know, if it's 20%, you know that's 0.2. If it's 100%, then you know that that is 1. Okay, that is what you basically need to know. And we have a scenario here where we're saying that in a product launch situation, the possible states of nature could consist of events such as a similar product being launched by a competitor at a lower price, at the same price, at a higher price, or no similar product being launched. So we are trying to see that we have different circumstances, okay? We have different scenarios that are happening. And from there, we can now rank the different probabilities. Like, for example, it's a case where we have a product launch. Ours is to rank and say, what's the probability that a competitor will come with a lower price? Maybe it is 0.2. What's the probability that a competitor may come with a high price? Maybe this is 0.5. And then what is the probability that a similar product will not actually be launched at all? And maybe we can know that maybe since the other was 0.2, the other 0.5, that's 0.7. So the 0.3 should be for no similar product being launched. Okay. Yeah. So that is just so you know more about how probabilities work. So we have a scenario here of a probability distribution. Okay. And we are going to see a scenario. So we have a scenario here that we are going to use to to understand more about probabilities. And this scenario says a tutor indicates that the probability of a student passing an examination is 70%, is 0.7. And then it means that, of course, the alternative of this meaning that a student does not pass the exam is, let's say, 0.3, okay? So if we are to draw up our probability distribution, okay, we shall basically list all the outcomes. The outcome, for example, in this scenario is pass the examination, which is 0.7. And then the other scenario would be, let's say, not pass the exam, which is 0.3. So you can see outcome with the respective probability. So it's basically a probability distribution. Okay, that's our probability distribution, and definitely this should add to definitely to 1.0. Okay, yeah. So of course, like we have seen like such a scenario, we also need to basically understand that some probabilities can either be objective or subjective. Okay, can either be objective or subjective. And I gave you an example, like for example, tossing a coin. That if the likelihood that you get, let's say, a head will, let's say, be 0.5. Now that is sort of an objective probability. But if when it comes to subjective probability, for example, the scenario we had of the likelihood that if we launch a new product, the possibility that a competitor will come up with a product of a higher price, product of a lower price, and maybe no product comes up. If I was to determine respective probabilities on each of those outcomes, you'll see that what I'll have might be totally different from what another expert might have. And our differences might be basically because of our exposure and because of our experience and because of our interpretation of the different market situations. Okay, so in that case, those are actually called subjective probabilities, and the subjective probabilities are so much common when it comes to business because the dynamics of businesses keep on changing and they are not like mathematical in nature, like for example tossing a coin. Okay, the scenarios of the market are a bit I don't know how to bring it, but they are not like straight. Okay, they are not like straight, and in that case we do what we make what we call the subjective probabilities. Okay, so you know that in business when we are speaking about probabilities, most of these are actually subjective. Okay, so once we have that in mind, we have okay, so we have a case here. We have an example here. So they're saying consider such an example. This is example, which are saying that a situation where a tutor is asked to state whether student A or student B will pass an examination. Okay, the tutor may reply that both students are expected to pass the examination, but in case he will go ahead to even give more in terms of the likely outcome, like who is more likely to actually pass the paper compared to the other. So for example, right here, we have student A probability and student B probability. So in this case, we can see that to pass examination for student A, the likelihood is 0.9. Okay, maybe this student is serious, they concentrate, and they have chances of actually passing the exam. And that means the other alternative percentage is 0.1. Similar to student B in the same way, the probabilities of them passing 0.6, and the other alternative is say 0.4, which gets to 1. Okay, as you can see, these are basically subjective probabilities. Okay, maybe the tutor, by just the way the student participates in class, is making such a decision, okay, on what kind of level of outcome could be for each of these students. So that is something, so you can get an example of that. Okay, so we have another example here, okay, that can help us understand more. So it's more about two products. Okay, so we are saying that a manager is considering whether to make product A or product B, but only one can be produced. Okay, they are saying the estimated sales demand for each product is uncertain. A detailed investigation of the possible sales demand for each product gives the following probability distributions. Like we said, probability distributions is basically the outcome and then the estimated probability, okay? Now, one of the things that is coming in here also is the weighted, okay? Now, the weighted is like our expected value, okay, on each of the outcome. And how do we calculate expected value? Expected value is basically this times this, okay? Basically, you're trying to multiply the probability with the respective outcome, okay? Yeah, so we have a probability distribution here. This is for product A. So for product A, if we have profits of 600,000, the outcome of profits of 600,000, the probability is 0.1. And that gives us a weighted of 60,000. Profits of 700,000, that is 0.2 and gives us 140,000. Profits of 800,000, this is the probability is 0.4. And when you multiply the two, you get that. So a very similar thing also would come to, of course, product B. But after you've done your weighted, okay, after you've done the weighted, then you can be able to get the total, which is our expected value, okay? And later on, we look at our product B, as you can see, if we are trying to look at outcome for profits of 400,000, this has a probability of 0.05 and so on. Profits of 600,000, this has 0.1 and it goes on like that, like that. So at the end of the day, the total outcome here is 1.00, and that alone would go ahead to give you expected value of 890. Now, based on these two products, okay, after we have done the respective calculating the respective expected value, as you can see there, we have 800,000 and down we have 900,000, okay? We have 890. So you can basically make a decision and say that product B is actually much better, okay? You can say that product B is actually much better than product A, okay? So that is very important so you can understand when you have such scenario. So in this scenario, we are bringing in the expected value, okay? We are bringing in the expected value, which is a common thing when it comes to working with probabilities, okay? And since this is in a business setting, we understand that once we are using expected value, then we can be able to make the decision on what product to actually take, okay? So that's very important so you understand. So make sure that you know what expected value is, especially here. Like we have said, expected value is basically the weighted. It is this weighted. It's basically this weighted arithmetic mean of possible outcomes. Okay. So the total we've gotten down here is basically our expected value when it comes to product A's outcomes. Okay. So that is something that is very important. And now once we do have that and we have that in mind, ours is also to look at, of course, just talking about the expected value. And right here, we are saying that between the 800 and 890, we'll definitely go with product B because it is expected that it will give us the highest average profit in the future, okay? Basically, the word expected value is also sort of like average, okay? Yeah, it could be like average. So you basically know, okay? So it represents the long-term average of the different outcomes, okay? So expected values, of course, they also have some limitations on them, okay? But even before we look at the limitations, I think for you, so you can know that when it comes to expected values, they also have advantages. And some of the advantages that you could be looking at here, for example, they help us reduce the information down to only one number for easy choice, okay? So like you have seen, and you can basically note that one of the advantages of what expected value, helping us to reduce to one number. Like you've seen, we had different outcomes here, and we had to make sure that we get the average, weighted average, which is 800, and then we also got our 890 here. So when you compare the two things, basically your work has been eased. Okay, you is trying to make a decision between the two items. Okay, so that is important for us. And then once you get down, okay, understanding that also means that we also, one of the other advantages that you can also maybe basically look at is the aspect that expected value brings in the idea of average. Okay, and by bringing the idea of average means that it's much understood by most people. Okay, when somebody speaks about the average profit that maybe a given product will give us, then it makes decisions much easier, even to somebody who is not well an expert when it comes to aspects of probability. Okay, yeah. So part of the limitations, or what you may call the disadvantages, like we've seen, the probabilities used in the respective calculations come with a lot of subjectivity. Okay, and this also comes with the disadvantage of probability itself. There's a lot of subjectivity that comes when we are deciding on what probabilities we need to rank for each of the different outcomes. Okay, and then also one of the things that you also need to know is that expected values are long-term averages. As we have seen, we have looked at profits at different levels. We've looked at profits at 600, profits at 800, and so on. So in cases where we want to make, let's say it's a one-off decision, then we see that this may not be maybe much applicable. Okay. So, and then one of the other things that also need to know that expected values should also do not go ahead to include the attitude of risk for the managers who are involved in the process. Okay, and as we proceed, we shall try to see how managers that have different attitudes to risk are able to make decisions on different outcomes. Okay, and then also time value of money is not taken into account when using, as you have seen up, when we are trying to look at, let's say, profits of different outcomes. Now, this could be, let's say, maybe this could be maybe in year 1, this could be in year 2, it could be in year 3, year 4, or year 5. Okay. Ideally, we've just looked at the outcome with the probability, but we've not gone ahead to look at the value for money. Okay. What somebody else could do a calculation of NPV and get maybe the net present value. Okay, so but with expected value, we don't have to go into looking at the value for money, which means that in one way or the other, it leaves out that aspect of value for money. Okay, which is very important, because we might be getting a profit of over $1 million shilling, but when in reality, when you look at its present value, it's just 500,000. Okay. So that's very important. So with that in mind, it's also good for us to understand one of the other things that you may also know when it comes to expected value. And what I want to talk about is the aspect of profit tables. Okay, what I want to speak about here is the aspect of profit tables. And profit tables, I just want to give you a scenario of how profit tables might be like. Just try to do an Excel here. You might get a question that could have profit tables. Okay. So how profit tables basically work. Okay. We are going to use a scenario here. Okay. We are going to use a scenario. So this scenario says that we have, for example, this could be, we have a cake vendor. Okay, and this cake vendor pays UJEX 1,000 per cake. They actually they pay 1,000 per cake. This is per cake. Okay. And then they sell this cake. They sell this cake at 3,000 shillings. Okay. Still per cake. Okay. So at the end of the day, any cakes that are sold are thrown away. Okay. Any cakes that are not sold are thrown away. Okay. So we go ahead to get our probability distribution table on different levels of demand. So this is how our distribution table will look like. So we have number of cakes. So the number of cakes here, we have scenarios of 200. This is like demand. We have a scenario of 400. And then we have another scenario of actually a 600. Okay. So once you have that, now it gets to probability. Okay. Probability that we shall sell 200, 400, and 600. So this is 0.3. Okay. And then this is 0.5. And then this is 0.2. Okay. So we know very well that when it comes to probability, this should basically add to 1. Okay. As we have it right there. So somebody can ask you to construct what we call a profit table. Okay. You can be asked to construct a profit table. So basically a profit table, in the way to draw our profit table, what we basically do is we look at the different orders in terms of demand. Okay. And then we also look at the aspect of probability as well. Okay. We look at the aspect of probability. So in terms of our table, what we shall basically have here is we shall have the order. Okay. So for example, we have, like we indicated, we have 200 cakes, then we have 400 cakes, and then we have 600 cakes. Okay. That is in terms of our order. Okay. So, and then one of the other things that we're also given is the aspect of the probability. Okay. With the respective demand. Okay. So we have a case scenario here where we have, when it comes to, just so you know that this is our demand. Okay. And this is we are going to look at the respective probabilities, which is 0.3. Okay. Which is 0.5. And then the other, which is 0.2. Okay. Like that. And remember, we still have our 200 here, and then have at the 600, this 0.3 is for 200, the 0.5 is for 600, this is 400, sorry, and then this is 600. Okay. So what we do with basically our profit table right here is to try to calculate, okay, for each of our items. For example, we have order size 200. Okay. Let me just try to do a work here. So for our order size 200, ours is to look at, remember they told us that these cakes are bought at what? At 1,000, and then they are sold at 3,000. Okay. So if the order size is 200, it means that our sales would definitely be what? Would be 200 times 3,000. Okay. So it will be 200 times 3,000. And it means that our cost of sales will definitely be what? Remember they told us we buy at 1,000, okay? So it will be 200 times 1,000, okay? Which gives us the difference, which is 400,000, okay? So once we have this, we can now input our what? We can now input our profit. Remember, this is a profit table, okay? So it means that what I'll do, I'll come and put the 400 there, okay? So I'll do the same thing when it comes to okay, so I'll do the same thing when it comes to, maybe I'll just try to push this side, okay? And put this here. So I will do the same thing when it comes to the 400. So if it's 400, it will be basically 400,000, 400 times 3,000, okay? And then my cost of sales will still be 400 times 1,000 to give me that. So when I try to get the difference right there, okay, now before I get the difference here, I may need to clarify something very small here. Okay, so we have the scenario one, like we've indicated that if at all we let's say our order is 200 and our demand is 200, it means that we actually our sales will actually be based on 200 and our cost of sales would also be based on 200. Now, when we come to scenario 2 here, okay, our order is 400, okay? Our order is 400 and our demand is, let's say, 200, okay? I hope you're getting the picture. So, and then when we come here, this would mean that our order is 200, okay? But in terms of our demand is 400. Now, if I'm trying to look at this, maybe just separate this scenario and this scenario. If I'm trying to look at this, I can try to repeat it here. If I'm trying to look at this scenario, I'm trying to look at my order is actually 200, but my demand is what? Is 400. So it means that my sales, remember your sales are determined by your demand, okay? It means that my sales will be what? Because my order is 200, it means that even if I have a demand of 400, I will still have to only sell the 200, okay? I'll still have to sell only the 200. So that is something that is very important. And it means that, okay, in the same way, still what I'm buying from the other side will still be the same thing, okay? So that is why when it comes to under here, where I'm going to put the next value, I'm going to do this. I'm going to look at my sales. My sales will still be 200 because that is what I have ordered, okay? Times the 3,000. And then I'm going to still less what? I'm still going to less 200 times 1,000 because that is what I have ordered, okay? I think you will learn it when we try to look at another scenario. So times 1,000. So this will still give me the same what? Will still give me the same thing. Just try to do this. So it's basically 600 minus 200,000. Okay, I'm just adding them because of the Excel. Okay, so here I have my 400,000. So here you basically see that I have 400,000. So I'm going to do another scenario. So another scenario here is where I have the demand of 600, but remember my order is what? My order is 200. Okay, So it means that in the same way I cannot meet the demand, I'll still only sell what I've been able to get in terms of the order. So my sales will still be 200 because that is what is available, okay? Even if my demand is 600, I cannot meet the whole 600. So this will be 200 times 3,000, and then less, definitely my order is 200, still to be 200, equal sign 200, maybe I'll put negative here. Times still 200. So you're seeing that I'm sorry, this is times 1,000, which is our cost of sales, okay? So giving us the same value. So under 200, when it comes to order size 200, that is what you've seen, okay? Now we're going to see how the scenario would be. So this will still be 400,000. How the scenario will be for 400,000, maybe that will help you to understand. And then you can do the other. So if, for example, if we have 200, this is what is going to happen. Now, remember, we're also trying to look at your sales. This is your profit. And the reason why we call it a profit table is because of that. We were trying to determine profit in different scenarios, okay? So in this scenario, when we have our order size 400, okay? When we have our order size 400 and then we have a demand of 400, this is what will happen. It means that our sales will still be 400 times what? Times 3,000, which we sell the cake on. Then our cost of sales will be what? Our cost of sales will still be 400, okay? Are we understanding this? Or it's confusing you? Can I get a comment? Are we understanding this?
Hello.
Pardon?
Yes, I'm following. I think I'm understanding it.
You're understanding it, eh?
Yeah.
Okay. Yeah, basically, maybe also just to note, what we are trying to do is a profit table, okay? And sometimes this is called, we call it a payoff matrix, okay? Some other people may call it a payoff matrix. So basically, we're trying to compare two scenarios. We're trying to compare a scenario where we have a given level of demand, okay? And then a given level of sales. So maybe let me even try to ask you here, since you're following. So if, for example, we have order 400, okay, which we are ordering from our supplier, and then we have demand of 200, what will be our revenue? Can somebody try?
Yeah, our revenue will be 400 times the 3,000, which is the selling cost. No, which is yeah, the price at which we are selling. We are selling at 3,000 each, which is 120,000.
Okay, let me repeat for you the scenario. Okay.
Yeah.
You order 400 from your supplier. Okay, that is what you've ordered.
Yeah.
But your demand is 200. What will be your sales?
Your sales is definitely it is at 200 times 3,000, because that's
brilliant. That times 3,000. So what will be your cost of sales?
It's again the 200 times 1,000.
But remember, you ordered for 400 that came to your premises. Would you still use 200? Remember, your order size is 400, and you sold. Your demand is at 200. Okay, your revenue will be the 200 times the 3,000, which we have done. But in terms of your cost of sales, remember they also told us when it came to this scenario, they told us that any cakes that are not sold are thrown away. Okay.
Yeah.
So what would be your cost of sales here?
I think we now take the entire cost that we incurred for the order. Now, I think now for the entire order of 400 times 1,000.
Times 1,000.
Since
Okay.
we've done that one, we are not going to sell, but we're going to throw it away.
Okay. And our profit here would definitely be this minus this. Okay. So let's try out this together in the same way. You have an order of 400 and 400 demand.
Yeah, this is again, it is 400 times 3,000.
Times 3,000.
Yeah.
And what you have in terms of cost of sales
is 400 times 1,000.
It is 400 times 1,000. The reason why we're still using 400 is because your order is actually also is still 400,000. Okay. So basically here the two things are matching. Okay. And that would mean that when it comes to here, it would basically be what? It will be the sales, since this is 600, remember the demand is 600 and your order is 400. So what will be the revenue?
It is 400 because we cannot meet the demand. What we have in store is only 400.
Yes.
So it's 400 times 3,000.
So this will be 400 times 3,000. And then cost of sales.
400 times 1,000.
This will be 400 times
1,000.
1,000. Okay. To give us the same scenario. So I hope others are also understanding that. Okay. And then it means that if we have our 600 in terms of order size, if we are trying to determine our sales right here, it means that if it's still under 200, our sales will still be based on what the demand is providing, which is 200 times 3,000. But since we are our order size is 600, it means that we have actually ordered 600 despite the demand, and the other will be thrown away. So it will be 600 times 1,000 to get basically nil. Okay. The same thing here. This is 600. Okay. Now our demand right here is actually 400. Okay. So our demand is 400. Our order size is 600. So it means that right here, this will be 400 times 3,000. But what we have in stock was actually the whole 600 times 1,000. So this will give us a difference of 600,000. Then lastly, under here, we have still, we are trying to see our sales are determined by demand, which will be 600 times what? Times 3,000. Then our cost of sales will be basically, remember, our order size is 600. So it will be 600 times what? Times 1,000, which will give us 1.2. Okay. Right there. So these are our respective profits in the different scenarios. So that would mean that this is what we have here under 400, and then this is what we have here under. So that is like our payoff table. Okay, or payoff matrix, whatever it might be called. So now once we have this, and we are going to see this kind of scenario. So once we have this as our profit table, okay, another question can be asked for us to calculate what daily order the vendor should actually place in order to maximize the expected value of the daily profits. Okay, so we have seen what has actually happened for the different orders. So basically the vendor is asking themselves, so what order should I make so I can maximize in terms of my, of course, profits? Okay, so what we shall do basically to attain that is we shall find the expected value in each of the orders. Okay, we shall get the expected value in each of the orders, and the expected value means that we shall look at the outcome vis-a-vis the probability. Outcome vis-a-vis the probability. So it means that if you are trying to look at order 200, basically what we shall do, and this you can also do it on your side, it is this times this, which gives us the weighted value of that response, plus this times what? Times this, okay? Plus this times that. So that will be our expected value for that outcome, okay? Which is 400,000. And the same thing that we shall also do, of course, if you're doing a written exam, you have to put the working down, but just for learning purposes, so you can know that we are multiplying this, the respective outcome with the respective probability, okay? Plus this times this plus this times this, okay? Like that. So it's the same thing right here, which will be this times this plus this times this plus this times this. So you see what we are getting. So we are getting 400,000 for order 200, then we are getting 600,000, 620 and 540, okay? So from right here, we can actually make a decision that order 400 gives us the maximum what? Gives us the maximum expected value, which reflects into the maximum profit, okay? So in advising this vendor, we should advise them to actually do what? To actually take the order of 400, okay? Given the market demand and supply. So I hope you're able to pick that. So that's what I wanted to comment about those profit tables, okay? So you can basically understand that. So with that in mind, ours is also to understand how, of course, how to minimize project risk and uncertainty, okay? We have different scenarios here. And as you can see, the first is through insurance. I think we've seen companies do this. The other one is through market research before you launch a product. That would definitely reduce on the project risk because you'll be able to understand how the market operates, okay? And then also and of course under market research there, yours is also to understand which kind of data you're collecting. So we have primary and secondary data, and then we have qualitative and then quantitative data, okay? You'll be able to catch this when you read the detailed information here. And then the other way to, of course, manage risk and uncertainty is the aspect of conservatism, okay? Conservatism is more of being prudent, okay? And this this basically involves you estimating the outcomes in a conservative manner, okay? And then that makes you only go for only the safest side of the decision, okay? Of course, this has its shortcomings as well, because you miss out on the other side of what? Of the risk ventures that might have better outcomes, okay? And then the other is also to use probability and expected values. I think we have seen this for the example we've just done of the profit table. And then the other is setting maximum payback periods over which projects should be rejected, okay? And this means that you basically, if you're doing an investment project analysis, yours is to say that any project that doesn't have a payback period that is within 5 years should be rejected, okay? And that alone makes you to either choose the project to continue with it or to actually reject it, okay? I think you know what a payback period is. Payback period is basically the period within which the invested money is actually reaped back, okay, by the business. And then the other one is sensitivity analysis, okay? Maybe to understand more about sensitivity analysis, we are going to look at that. But also the other one is making prudent estimates of cash flows, okay? So before we look at the aspect of sensitivity analysis, it's also one of the key things when it comes to making decisions, okay? Especially in uncertain situations, is the aspect of decision tree and the probability tree analysis, okay? Now, decision tree, of course, these are used in circumstances where we have some degree of uncertainty. I think we've seen the scenarios we've seen up are usually for cases where we have, it's basically risk environments, okay? But we see that decision trees come handy when we are trying to look at certain circumstances of uncertainty, okay? Circumstances of uncertainty, and this is represented by a diagram, as you can see right here, where this is basically where it starts from, okay? Where you have different decisions. It's basically, this is called a decision node, okay? This part is called a decision node. And also to understand that from the decision node, we have different lines that represent different outcomes, okay? Like that. Now, in cases where we have a given alternative with, again, extra situations of various possible outcomes, okay? Like, for example, I'll give you an example. If, for example, we're trying to make a decision here of, let's say, launching a product, okay? We can either say, it's either we launch the product or not. So we can have two different decision options. But then if we launch the product, we could also have scenarios of the product is much likely to be successful, the product is moderate to be successful, and the product is likely maybe not to be successful, okay? So with that, we use what we call this outcome point, which is a 0. So a 0 can actually start from this level, from after this alternative branch. So we can have a decision, an outcome point here that represents any other scenarios that might happen, okay, in case we make that kind of decision, okay? Yeah, and of course, like we said, every possible outcome is represented by a branch on its own, okay, coming out from the outcome point. So in the same way, if we have a 0 here, it can have different lines, okay? So that is important. So of course, one of the other things that you should also understand when it comes to decision trees is that these should actually be made in chronological order, at least from left to right, okay? So you start from the first, the different decision, we call it the decision node, okay? You start from the decision node and you include the respective alternatives, okay? And then from there, in case you have maybe an alternative that gives you different outcomes, then you come to include your outcome point, okay? So that's how basically we do. So, so you know, and of course, to draw this, you may just need something like maybe you can use a pen, a pencil, okay? And maybe just a ruler to make sure that you're very systematic, okay? Now, in evaluating decisions using a decision tool, what we basically do is we evaluate from right to left and calculate the expected values of each outcome. Okay, it's basically called a rollback analysis. Now you saw that when we are drawing, we say that we start from what? We start from the left to the other side. But when we are making the analysis, ours is to actually do what? Calculate the expected values of each outcome coming from what? From the right to the left. We are doing the reverse. Okay, that's why it's called a rollback analysis. Okay, and also so you know that for an outcome node, the expected value is gotten by doing what? By adding the expected value of the branches leading to the outcome node. Okay, so you basically you get the weighted outcome on each of the branch, and then you're able to add the rest all the branches to come up with what? To come up with the expected value. Okay, and then for the decision node, if we are dealing with revenues, we create different alloys that would lead to the highest expected value of the revenues, which are contributions. Okay, and then when we are dealing with costs, we need the alternatives that lead to the lowest cost. So we are going to try to see when it comes to decision tables, maybe before we look at the disadvantages, ours is to look at a scenario. Okay, we could actually look at a scenario here. So we have this scenario where they are saying that a company is considering whether to develop a new product, whether to develop and market a new product. Okay, that is what the company is actually considering. Okay, and they are telling us that the development costs are estimated to be 180,000, and there's a 0.5 probability that the development cost will be successful, and a 0.5 probability that the development effort will be unsuccessful. So as you can see, this is our first what? These are our first two alternatives that are coming from the decision node. Okay, so if we are to draw up our decision tree here, would start from this scenario. Okay, let me try to see if my paint here can allow me. Just right here. So if this is what I have, remember, said we start with our box right there. Okay, and that we call this our decision node. Okay, and we are saying that after that, ours is to now draw the different options. Okay, from here, and then right there also to draw another one. Okay, so as you've seen from what they have told us, that we have two scenarios. We have a scenario when the project development costs are successful, and we have a scenario where these are not successful. So we shall put the respective probabilities. Okay, so we have 0.5 and 0.25. So so we can have something here and say maybe this is successful. This is the successful node. Okay, and then maybe this can be unsuccessful. Okay, so once you have that, yours is to also look at scenarios of including the respective probabilities, like they indicated here. they told us that 0.5 is for success, for the project being successful. So I want to include the probabilities on the respective my program here. So this is, let me see, maybe this is 0.75. And maybe this is 0.25. Okay, so that is the scenario that I have. Okay, okay, so once I have that, remember they told me that in case there is one outcome has one of the respective alternatives has more outcomes, then I'll have now what we call the outcome point. Okay, so what this means is that they are telling me that if the development is successful, the product will be marketed, and it's estimated that one, the product is successful, the profits will be 540. If the product is moderately successful, the other one will be 100,000, and if the product is a failure, this will be 400,000. So what I basically need to do is to create an outcome point that is going to come from here. Okay, so what I'll basically do, just trying to disturb me. So what I'll basically do is I'll get my 0 and I'll start from here. Okay, basically definitely it should start from here. Let me just try to see if I can move this successful here, but it should basically start from here. Okay, so I'm going to have different scenarios. So I'm going to have scenario A, and I have another scenario B, and I have another scenario again. Okay, like right there. So what this would mean is that these are the respective outcomes that they have given me. Okay, and like indicated here, we have a scenario that is getting us 540, and this probability, this is 0.4. Okay, so you'll indicate that on the first line, and then this one, the 100 at 0.3, and then so on. Okay, so what I'll basically do, 540, 0.4. I'll just come right here and pick this, and maybe call this 540,000. And remember they told me that this is 0.4. Okay, so I might include the 0.4 right there. Okay, and definitely I'll get the other alternative outcome, which they are telling me this is 100 at 0.3. Okay, 100 and 0.3. So that would mean that this would be 100. The probability is 0.3. Okay, and then the last one, which is actually, this is 400,000. Okay, at 0.3. $400,000. This is also 0.3. As you can see, the total probability at a given outcome point is also 100. The same thing happens here. Okay, so that is the kind of scenario that we have. Okay, and that is how we are trying to represent it on our respective decision. And like of course they indicated to us that this is 180, the development costs are 180. So we just need to also include here, remember this first point of the 180. Both the two scenarios, we shall basically incur the 180, because either it is successful or not, we shall still incur the amount of money. Okay, so basically here has a 180 that we've incurred, and here also basically we also incurred 180. Okay, so you know. And one of the things that they also told us that when it came to the question, they told us that each of the above profit and loss calculations is after taking into account, actually this is a loss, the last option is a loss, sorry, taking into account the development cost of 100,000. So let me just try to update the other one and put a negative. This is a loss. So I hope it can pick up. Let me just put a negative right there. I hope that will work for me. Okay, so that is what I basically do have. So they have told that this 540, 100, and 400,000 that has already taken into consideration this cost. Okay, so what they're asking us, let's just look at the question. At least we've done the construction of the decision table. Okay, so they want us to illustrate the above information on a decision tree, which we have basically done. Okay, so basically, if at all they had asked us to determine which decision to basically take, what we need to basically do is to get the expected value on this respective outcome. So we'll be able to get the expected value here, and by getting the expected value on this outcome point, it will be 540 times 0.4, and then 100,000 times 0.3, and then for negative 400 times 0.3. Then we are able to add it together. Okay, and see that vis-a-vis the 180,000 that we actually invested in. Okay, in terms of the development cost. So that is just so you know, and that is based on this guidance that they actually gave us right here, where they are saying that we evaluate from left to right and calculate the expected values at the outcome point. Okay, yeah. And then to get, they are saying for each outcome node, the expected value is gotten by adding the expected value of each of the branches, which we have done. Okay, yeah. So that is very key that you understand more about these decision tables. Okay. Okay, so we have a scenario here, which we have just looked at. So once we have done that, us is also to appreciate the attitudes to risk by different individuals. Like I said, one of the disadvantages that we saw with expected value that doesn't take into consideration the attitudes of managers in terms of risk. Okay, so we also have different attitudes of individuals, which are our managers here. we have what we call the risk seekers, and then we also have what we call the risk neutral, and then we have the risk averse. Okay. Now, so we know that when it comes to the risk seeker, of course, these are people who basically you can call them, they are optimistic in nature. Okay. They will always look out for the best outcome, no matter what risk level is actually likely to occur. So for them, they won't take on any kind of risk, as long as, of course, as long as they are getting the highest possible outcome. Those are risk seekers. And individuals that are risk neutral are those that are basically, of course, when you give them two scenarios, one with more or less risk, then they end up basically choosing, their choice is not based on either high risk or low. They are basically neutral when it comes to element of risk. Okay. And then risk averse, those are usually people who are afraid to take the risk. Okay. And basically here what we're saying is that they basically assume, their assumption is based on the worst outcome. Okay. On what might occur, basically. So they are basically risk averse and they fear risk. Okay. And you can call them as pessimistic. Okay. So we are saying that, of course, this has an implication to managers. Of course, a manager who is working in an organization that is categorized by risk averse is likely to make decisions that are not congruent to the organization. Okay. So basically, your risk appetite should match the risk appetite of the organization, and in the same way, what the risk appetite of the investors. Okay. Yeah. So given that, also it's very important for us to also understand how to make decisions under uncertainty scenarios. Okay. Like we said, when it comes to risky scenarios, these are scenarios where we have some level of certainty in terms of outcomes with their respective probabilities. But then our question is, what if we actually have it's basically uncertain. We are uncertain of what might actually happen. Okay. And we cannot assign respective probabilities. Then right here, we come to use what we are going to call, we have different criteria. We have Maximin, and then we have Maximax, and then we have Minimax Regret rule. Okay. So, and how this is how it basically works. So we basically we draw up our payoff matrix. Remember what we've just done with payoff, the profit table that we just did, it applies rightly here. Okay. And as you can see, we have our state of nature, which can be high, medium, and then low. Okay. Just like the way we had different orders, and then we can have the respective payoffs. And we're saying the respective payoffs can be either net profit, contribution, or net loss, just like we calculated in the previous example. Okay. And then the state of nature can be uncontrollable factors that are outside the decision maker's control, and that might occur on the respective courses of action. Okay. So you understand, I think you'll be able to understand this more with examples. But for us to start on the first decision rule, now, this decision rule is looked at as a pessimistic approach. Like we said, decision makers who are pessimistic are decision makers who are risk averse. Okay. And what happens here is that the decision maker seeks to achieve the best results if at all the worst happens. Okay. And this means that in choosing alternatives, they will choose the alternatives that maximize the minimum profits. Okay. Reason why we are trying to look at maximize the minimum profits is this person is looking at what the worst case scenario. Okay. And they are choosing the best from the worst case scenario. Okay. It's basically a play itself basis for decision making. Okay. So it is max mini. And for you to basically understand, we have a scenario here, okay? We have a scenario here. So suppose a businessman is trying to decide which of the 3 mutually exclusive projects to undertake. Each of the project could lead to varying net profit under the 3 possible scenarios, okay? So we have scenario 1. These are the profits. These are like our pair of values that we have calculated the other side. So we have scenario 1 here, and then we have scenario 2, okay? As you can see, scenario 2 has 90, 120, and 85 under F. And then we can move just to see the previous, to see this now. When it comes to scenario 3, we have 20. We basically have a loss of 20, okay? And then we have a profit of 10, and then we have a profit of 85. So what happens with this so-called max mini is we look at the different scenarios, okay? We look at the different scenarios and determine the minimum profit, okay? We look at different scenarios and determine the minimum profit. So in this case, when you try to look at D, the scenarios, we have 100, we have 90, and then we have 20, which is a loss, okay? So our minimum here is basically the loss of 20. For scenario E, we have 80, okay? We have 120 and 10. So it means that our minimum profit under for project E is actually 10. So we write this. In the same way, when it comes to F, we look at 60, 85, and 85. And we come to realize that 85 is the lowest under this scenario. So if worst case scenario happens, we earn 60 shillings under project F. If worst case scenario happens under project E, we actually earn 10. Worst case scenario happens under project D, we basically get a loss of 20. So once we have determined the lowest values, okay, the 20, the 10, and 60, ours is to find the maximum profit of the 3 scenarios, okay? And as you can see, our maximum of these respective options was actually the one of 60, okay? So that is what happens with our max mini, okay? So you basically get your mini and get the maximum of the mini options of each of them, okay? Yeah, so I hope you understand the scenario. So maybe just to just give a similar scenario to what we just did here, is that if this is the scenario and these are our profitables, definitely my my mini here will be 0, okay? And my mini here will basically be 400,000, okay? And my mini here will definitely also be 400,000, okay? So it means that if I'm to find my max mini, basically it will be between these 2 options, okay? So that is something very important so you can understand. We are going to see another scenario that is going to help us pick this, okay? So as you can see, we've chosen our 60. So we have a criticism there. So we're going to see another scenario here. So they're telling us that the Maximax, we have another one called Maximax decision, okay? And like the way we've just seen, the other one was basically max mini. This one is Maximax. So it means that for this, we basically go and look out for the maximum profit on each of the lines. And then we determine which one is maximum, okay? So let's just go up here. So under project D, our maximum will be what? Our maximum will actually be 100, okay? So this will be our maximum, 100. Let me just highlight this. So that will be our maximum. When it comes to project E, our maximum is what? Our maximum is 120. When it comes to F, our maximum will be what? Will be 85. So if it is max, it means that we are going to select what? we are going to select the 120, okay? So that is what happens with Maximax, okay? And that is why they are saying the Maximax basically looks at the best possible results, okay? And it means, it says that this decision is more of from an optimistic perspective. And we said a risk manager is optimistic when for them they are basically risk takers, okay? They are aggressive and adventurous. They want to test and go for the risk areas, okay? So such decision makers choose to take actions that would result into what? Into the maximum payoff possible, okay? Like we have seen, using the example above, the maximum profit for project D was was 100, for project E was 120, and for project F was what? Was 85. So in this scenario, would actually choose project E, which gives us a higher maximum profit, okay? So that is what we did. We basically chose this one because it's the one that had the maximum, okay? So I hope you're picking, and in case you're getting any challenges, use the chat box, and then I can be able to clarify, okay? Yeah. Of course, it has its criticism, okay? And basically, it's they are calling it, it's a defensive and conservatism, because you're only looking at the better side of things, okay? You're not looking at what if things don't work out, okay? And then, of course, it ignores the probability of each of the different outcomes. Remember, here we are not looking at probabilities. We are just basically looking at the respective outcomes, okay? And then we have this other scenario. We have this other scenario, the one of Maximax, and the criticism. It's also ignores probabilities, and the other one, it is over optimistic as well. And then we have the max regret rule, which is our last scenario, okay? Now, the max regret rule, this one is also defined as the opportunity loss through having made a wrong decision, okay? Remember, regret comes when you make the wrong decision due to lack of facts and poor, let's say, forecasting of what the future might look like, okay? So the Minimax regret rule aims to minimize the regret from making the wrong decisions, okay? We are saying that this aims to minimize the regret from making the wrong decision. And how we look at it, it is the maximum possible value under that outcome, the difference between the maximum possible value under that outcome and the value which result from a particular action, okay? And that means that we actually going to draw up what? We draw up what we call a Minimax regret rule opportunity loss table, okay? So we are going to see how our table looks like. So this is how our table looks like. But for you to understand how you were able to get 0, 20, and 40, let's just go back to our scenario, okay? So you're telling us we get the maximum possible value, and then we get the value for each result under that action. So if you're to go up back here, if we are trying to look at this scenario, okay? We are trying to look at this scenario. As you can see, for project, let's say we have project D, and then we have project E and project F. Now, as you can see, like what they basically told us here, just a moment, sorry. We're basically trying to get the maximum possible value of that outcome and the value which results from each particular action, okay? Now, as you can see, we have scenario 1, we have scenario 2, and scenario 3, okay? Now, ours is to look at, let's say, the different scenarios, okay? So we have scenario 1, okay? And as you can see, we have 0, 20, and 40. Now we are going to see up here how we got the 0, 20, and 40. Now, do we see right here? 100 is our maximum on this scenario. Now, as you can see, when it comes to this max regret rule, is that we are basically looking at scenarios. We are no longer looking at the product. Okay, so when it comes to here, we are trying to look at scenario 1. Scenario 1, D has 100, E has 80, and F has 60. Okay, which is our maximum? Our maximum is 100. So when we get our maximum to be 100, we now subtract each of these points from 100. So here we shall get 0, here we shall get 20, and here we shall get 40. Okay, so 100 minus 60 gets you 40. Okay, so that is how we shall construct our opportunity loss table for the first line. When it comes to scenario 2, our maximum is what? Our maximum is 120. So it will be 120 minus what? Minus 90, which gives you, I think, 30. Then this will give us a 0, and this will give us this. I think this is a 35. Okay, so you're going to see that reflected when it comes to our scenario here. So that's why we have 30 here, we have 0 here, and then we have 35. So if you do the same thing for this other last scenario, okay, we can try to see. Remember here we had 20, a loss of 20, then we had a profit of 10 and 85. So this is our maximum. Okay, so we are saying that if we are to get 85 and less 20, remember this is a negative. So 85 minus 20 gives you 105. Okay, and then when it comes to this, 85 minus 10 gives you 75, and this gives you 0. So that is exactly what we have just right at the bottom there. Okay, we are going to see it happen. So right here, as you can see here, we have 0, we have 75, and we have 105. So what happens? This is our opportunity loss table, the one we have drawn. So the maximum regret, remember, we go and get the minimum here. Okay, as you can see, we are saying that the lowest of the maximum regrets is 40, which is for project F. So project F would be selected if we are trying to look at the minimax regret rule is used. Okay, so that is what happens with this so-called minimax regret rule. Okay, so the whole thing that you need to do as your takeaway is how to determine the opportunity loss table. Okay, so that is very important for us right there to know. Okay, yeah, so this was just another example, okay, to help you to understand. You forgive me about my Word document, it's a bit distorted, but it's basically the same principle. Okay, you just need to know how to draw up that loss table. Okay, so that's important for you to understand. Contribution tables, we already did a contribution table, just like the way we just did the profit table that I just calculated for you. That would be something to do with the profit table. Okay, now ours is now to also understand how sensitivity analysis is. Remember, sensitivity analysis was one of the ways to manage risk and uncertainty. Okay, now by sensitivity, here we are trying to look at a what if analysis. Okay, when somebody says sensitivity analysis, this is so much to do with what if analysis. So it's basically trying to describe a technique where decision options are tested for their vulnerability to changes in any variables, such as expected sales per unit, sales price per unit, material costs, labor costs, etc. Okay. So sensitivity analysis also, for you just know that it can be used for a situation so long as the relationship between the variables can be established. Okay. So we are going to try to see, but before that, also to understand that sensitivity analysis also has respective approaches, and these are 3 in number. So we have one of the first approach is to establish, is basically estimating how much cost revenues would need to differ from their estimated values before the decision would change. Okay. And then once that is done, also the other one is to estimating whether a decision would change if estimated costs were, let's say, a given percentage higher than the estimated revenues, as well as also maybe either lower than, let's say, maybe the estimated expenses right there. Okay. And then the other approach could be estimating how much costs and or revenues will need to differ from their estimated values, okay, before a decision maker makes a decision between 2 options. Okay. So we have and one of the things that you also need to understand is like we've said here, we're trying to look at a what if analysis. Okay. We're trying to look at a what if analysis, and once we are doing sensitivity analysis, basically we need to understand that, of course, we can try to use information technology, that is IT, okay, which can be maybe through spreadsheets. Okay. We can also use things like, let's say, linear programming. Okay. And we can also use flexible budgeting is also a form of sensitivity analysis. Okay. Now, sensitivity analysis has certain weaknesses, but before the weaknesses, we can just try to see a question here that can give us this picture. Okay. So since VITE has estimated the following sales and profits for a new product, which it may launch to the market. Okay. So we have sales for 2,000 units stands at 4,000. Okay. So it means that the unit price here is at 2. Then we have variable costs. We have materials. We have 2,000, and we have labor at 1,000. Okay. So in total of our variable cost, this is 3,000, and our contribution is basically 4,000 minus 3,000, which gives you 1,000. And then we have less incremental fixed costs, and this will definitely give us a profit of 200. Okay. Now here is the question. They're asking you, analyze the sensitivity of the project with respect to what? With respect to the fixed costs, with respect to the variable costs, with respect to the labor costs, with respect to the material costs, with respect to the selling price, with respect to the sales volume. Okay, different parameters. Okay. Now, so you know that the sensitivity we are going to look at here is profit, which is our NPV, divided by what? Divided by the present value of the project variable. Okay. So our first item here is fixed cost. Now ours is to look at what is our profit. Remember, our profit we got at the bottom here was what? Was 200. Okay. Divided by the variable, which is our fixed cost, item 1. Our fixed cost, as you saw up here, they were actually what? They were 800. So you're able to get your sensitivity, which is 200 divided by 800 times 100% gives you 25%. And as you're going to see here, the comment, this means that fixed costs will have to rise by 25% if a project remain profitable. Okay. And if incremental fixed costs are more than 25% above estimate, this would make a loss. As you can see, we are trying to look at what is the effect of change in, let's say what? Let's say in fixed costs. Okay. And that is the same thing that we talked about when we are trying to define the sensitivity analysis, okay? So it means that if we are trying to look at the variable cost, in the same way, we shall look at what? We shall still look at our profit, okay? Which profit is 200 and divide it by what? Divide it by 3,000, which 3,000 was actually our what? Our respective total of variable costs, okay? Right there. Basically, we're trying to look at how each of the parameters actually affects, okay? As you can see, maybe just to just take you through back here, just a moment. Okay. Like we said, we are calling it the what if analysis, okay? And we're saying that this describes a technique whereby decisions are tested for their vulnerability to changes in any variables, okay? And we are getting the respective variables that we could have. So in the example we have, we're trying to look at scenarios of changes in our fixed cost, changes in our variable cost, and so on, okay? So basically that is the principle, okay? That is basically the principle. So that is what you do. If it's labor cost, you still go get 200 divided by the labor cost like that. And then you're able to comment that your labor costs will have to increase by 20% if the project is remain profitable, okay? The same thing with the material cost, the same thing with sales price, and then sales volume in the same way, okay? Like that. So you're able to get that. So we're saying management would be able to judge more clearly whether the product is likely to be more profitable. And we're saying the item to which profitable is more sensitive in this example are selling prices, okay? Because, and then the other one is 6.7%, which is for variable cost, okay? And we're saying that management should concentrate and put attention to these most important factors that have a greater influence on its profit, okay? So that is very important, okay, to understand. So once we have that in mind about sensitivity, I'd want to bring in this aspect of value of information, okay? Now, once we are making decisions, okay, and remember we are making decisions both in uncertain and risk scenarios, we are saying that basically value of information is, remember, if you have information, then it means you make better decisions because you're informed, okay? But also understanding that the value of information should not exceed how much you're incurring on that information. Basically, what you're going to get from the information should be not any less than what you incur, okay? So there should be a profit from getting information, okay? So we have here, we're trying to say that we have two scenarios. Information may be perfect or imperfect, okay? Now, perfect information is information which predicts with 100% accuracy that the outcome situation will actually be, okay? So there is no elements of uncertainty. It basically removes any doubt and uncertainty from a decision, okay? So this person will tell you that this will exactly happen. In 2022, we shall have zero COVID and business will be up, okay? So like that is perfect information in its own, okay? So when we are speaking up, when we are trying to look at value of perfect information, okay? We basically look at two things. Is basically get the difference between the expected value of profit with perfect information, and then we subtract the expected value of profits without perfect information, okay? Basically, we're trying to see if we are trying to make decision based on information available, what do we benefit than us making decisions when we are not basing on any kind of information, okay? So that is what we are basically trying to do here when it comes to determining our what? Our value of perfect information, okay? So if we are trying to look it in terms of steps, of course, step one is if we don't have perfect information, then we must choose between two or more decision options. Then we'd select the decision option which offers the highest EV. Okay, this is a case where we don't have, of course, where you don't have perfect information. Okay, where we are saying that we select a decision option which gives us the highest EV of profit. Okay, now this option, of course, will definitely, of course, be the best, not be the best option under circumstances, because there will be some probability that if we select this, it means that certain events may actually occur. Okay, and then we have the step two, which looks at where we have perfect information. Okay, remember we said that we get scenarios where we don't have perfect information, and then a scenario where we have perfect information. So where we have perfect information, it means that the decision is selected will differ according to what the outcome situation will be. Okay, now in making the decision, we shall basically look at something that gives us a highest profit or a lowest cost. Okay, so we are going to see this when we are trying to look at an example here. So after step three is getting the difference, the EV of profit with perfect information, and then the EV of profit without perfect information. So we have a scenario here that tells us that the management of KCCA must choose whether to go ahead with either of the two mutually projects, okay, mutually exclusive projects, okay, which is project A and project B. Now, of course, mutually exclusive means projects that cannot be run together. Okay, that is what exactly happens. So we are saying we have two scenarios here. We have scenario A, option A, and option B. We're saying profits if strong demand for project A, we have 4,000 and 1,500. Then we have profits if moderate demand, 1,200 and 1,000. Then we have scenario profit if there is weak demand, okay, 1,500. And then we have the respective probabilities there, okay. So they are telling us, this is what they are telling us. They are telling us that ascertain what the decision would be based on expected value if no information about demand was available, okay. If we didn't have information about the demand, okay, they are telling us that ascertain what the decision would be, okay, based on expected value if we are told we had no information. And then they're also asking us to calculate the value of perfect information about demand, okay. Yeah, so just to give you a scenario here, so like they gave us, remember they gave us different scenarios, okay. They gave us different scenarios there for project A and project B, as you can see. So ours is to rearrange this and have different scenarios. So for project A, as you can see, 4,000 had a 0.2 probability, okay. So the EV here is 4,000 times 0.2. Project B, or project still under project A, for this scenario where we have moderate demand was 1,200 and the probability was 0.3. So able to get that. And the same thing we do for a scenario where with weak demand, 0.5 times that, we're able to get a loss of that amount. The same thing we'd also do for project B, okay? We are able to get 1,500 multiplied by, of course, the 200. 1,000 times the 0.3, and then 500 times 0.5. And then we're able to get the summation of EV under this area. So we get 660 and 500, 850, okay? Now, of course, they are telling us that ascertain what the decision would be based on expected values. So based on expected values, as you can see, we are trying to see that project B looks more attractive, okay? Because these are the expected values that we've calculated. This project looks what? Looks more attractive, okay? So definitely would go ahead to go with that project. Now, ours is to ask ourselves, now, what if we now have what? We have perfect information about demand, okay? Where whatever demand you've seen up here, these scenarios, it is basically perfect information, okay? It's not basically information that is just determined through maybe intuition, but it is perfect demand. So what we are saying there is, for us to calculate here, we have to work out what? The expected value for maximum payoff under each of the scenario, okay? The expected value for maximum payoff under each of the scenario, because you basically have perfect information. So when it comes to element of strong demand, let's just see a scenario up here, okay? So aspect of strong demand, definitely under here, you would basically take the 4,000, so which will be 4,000 times the 0.2, okay? And then when it comes to moderate demand, you have 1,000 times 0.3. So just so you see how that is reflected here. As you can see, 4,000 times 0.2. The same thing with 1,200 times what? The 0.3. Now, in the same way, we look at scenarios where we have weak demand, okay? Weak demand, we see that under weak demand, project A gives us a higher payoff, okay? So we're able to get that as well, 1,000 times 0.5, okay? Which is giving us that scenario. Just a moment. This is so it's actually 0.5 times what? Times the 500. Sorry. Okay. Which gives us what? Which gives us the respective 250. Now, right here, when you try to add 800 plus 360 plus 250, that gives you 1,410, okay? So for you to determine the value of perfect information is basically what you made choice here. Remember, we made a choice of 850, and then we are now subtracting what? We are now subtracting the EV of profit with perfect information, okay? Now, so you just reference you back here, maybe for better understanding on what we said when it came to the steps. Maybe you better understand the steps now. Remember, they told us that our step one, if we do not have perfect information, okay, and we must choose between two or more decision options, we would select a decision option which offers the highest EV of profit. So as we did that, or they have also told us, or lowest EV of cost, based on the scenarios, okay? And they're saying this decision will be the best decision under all circumstances. Now, when it comes to our scenario here, I think that is what we exactly did. We determined our EV, okay? And we were able to determine that project B had a better choice, okay? And then when we come to step 2, we say that with perfect information, the best decision option will always be selected. The decision option that is selected will differ according to what outcome situations will be. The choice will be the outcome that gives the highest profit or lowest cost in circumstances, okay? We will know. And we then calculate the EV of profit, okay? So in this scenario, as you can see right here, okay? Ours is to look at this. Now, right here, the best we could get is 4,000 times the 0.2, okay? And the best year would get was 1,200 times 0.3. Now, under weak demand, our best is 500, okay, times 0.5, because this is the negative, this is the loss, okay? So that is why we got 4,000 times 0.2, which was about 800, plus 1,200 times this, which is, I think, about maybe about 240, and then this 500 times 0.5, which gave us the, I think, gave us 250, okay? Gave us 250, just a moment. It gave us the 250. So once you add the two things together, this is another question. It's another example, okay? Right here. So as you can see, when you get 1,410 minus 850, you actually get 560, okay? Once you've added this. So that alone, okay, the interpretation is that provided information does not cost more than 560, okay, which is the difference, it would be worth having on assumption that the EV decision is applied, okay? So in cases where KCCA wants to make a decision whether to get information, for example, from a consultant, after getting this scenario where there is perfect information and where there is no perfect information, and getting 560, it means that getting perfect information is actually worth it because it gives us a higher return compared to the other scenario. But the value of that perfect information should not really be at least, should not cost us more than 560, okay? Because if it costs us more, 560, it means that the benefit vis-a-vis what we are getting will actually be not make sense, okay? Yeah. And then lastly is the issue of imperfect information, okay? Now, imperfect information is where you don't have 100% uncertainty, okay? And here we're trying to say it is better than no information at all, okay? But could be wrong in its prediction of the future. So yes, you understand, like I gave a scenario of, let's say next year, you may hire a consultant who may tell you that maybe next year there will be no COVID, okay? Now, in that case, that may not be perfect information because you know that circumstances may change, but maybe they have different factors that they have looked at. Maybe they have looked at scenarios of vaccination and so on. But yours is also to see that now, what if, okay? What if maybe another pandemic comes up, or what if things just turn around, okay? So in that case, that would be a case of imperfect information, okay? So what we are saying that, of course, imperfect information comes in because of the drawback of perfect information. Like we cannot have really perfect information, especially in the business environment, okay? So one of the things that we are seeing here is that when it comes to calculating imperfect information, let's just see a scenario here that will give us a better picture. So we have a company wants to make a decision between two mutually exclusive options, A and B. The profits from each option will depend on the state of the economy in the next in the next 12 months, that there is 60% probability that the economy will be weak, okay? Now, of course, the 40% probability is that the economy will be what? Will actually be strong. Now, the probability with each decision would be as follows. This is what we have. So we have option A and then we have option B. So for weak economy, we have 50. And then option B, we have 20. Okay, remember they have given us the respective probabilities for weak economy and of course the economy that is a bit better. Okay, and then or strong. So we have 60, and then we have 100,000. So we have the respective outcomes with the respective probabilities that we have there. Okay, So they go on to tell us that research could be carried out into the state of the economy in the next 12 months. It has been estimated that if the true state of the economy will be weak, okay, there is 80% probability that the research would predict this correctly. Okay, I repeat, it has been estimated that if the true state of the economy will be weak, there is 80% probability that the research would predict this correctly. It is also estimated that if the true state of economy will be strong, there will actually be what? There will be 90% probability that the research would predict this correctly. Okay? So they are asking us to calculate what? To calculate the value of imperfect information. Okay? Now, in this scenario, to calculate the value of imperfect information, we basically get the EV of profit if information is available and EV of profit if no information is obtained. Okay? Now, scenario A, the EV of the value of decision without information, basically what we are going to try to look at here, if it's option A, okay? If it's option A, what we are going to basically do is just do the normal thing, okay? Remember, option A has a scenario here. We have 550, okay? 50, and remember for 50, the probability for week for the week was 60, and then the other one was 40. So I'm going to do 50. Okay, since it's under week, I'm going to multiply that by 60, and then I'm going to multiply 60 times what? Times 40%, because that is the scenario that is under. So I'll be able to get my 54. For option B, I'll do the same thing. I'll basically come right here and get 20, multiply it by what? Multiply it by the 60, which shows wiki, and 100, multiply it by 40%, okay? So those two things would definitely give me 52,000, okay? Now, of course, in making the decision here, these are EVs, these are expected values that I'm using here. And with the expected value, mine is just to choose between what gives me the best expected value. And as you can see, option A would give me, so I would basically select option A of the 54,000, okay? And then we have a scenario where we have imperfect information. Now, when I'm doing imperfect information, this is what I'm going to look at, okay? So we have actual state of economy, okay? And then we have research prediction, and then we have the decision, then we have the profit probability, and so on, okay? So this is how the scenario is going to be. So we have, just a moment, sorry. So we have actual state of economy if at all it's weak, okay? If the actual state of economy is weak and the research prediction actually informs us that it's weak, okay? Option A definitely will be the 50,000, okay? Because under weak, option A gives us 50,000. But then what happens with the probability, okay? Now, I think you can see that from here, they told us that the probability that there will be a weak economy is what? Is 60%, okay? Now, research, they're telling us research could be carried out in the state of the economy in the next 12 months. It's estimated that if true the state of economy will be weak, there will actually be what? Will be 80% probability, okay? That the research would predict this correctly. It's estimated that if the true state of economy will be strong, they will be 90%. So if I'm trying to look at the value of imperfect information, I'm going to get the 80%. If I'm trying to look at weak, I'll look at the scenario where we have a weak economy, which is the 60%, times the case where the research comes out with actually a weak. So that is what is giving us the 0.6 times 0.8, which gives me the 0.48. So this will be the probability that I'll subject on what? On my 50,000, okay? So if I'm trying to look at weak, strong, okay? Actual state of economy is weak, and it is, let's say, option B. Remember, for like we indicated, option B under weak, as you will see up, is 20,000, okay? So I'm going to get 20,000 times the 0.6 for up, okay? Then times what? Times this so-called, let's say what? The research is telling us when this is strong, okay? The strong probability is actually 0.2. That's why I do 0.6 times 0.2. You can also arrange it. You can make this the same thing. For example, you can do option A, weak, then you can do weak, strong, and then strong, weak, okay? Respective. But all after this, yours is to make sure that you determine the respective EVs, okay? By multiplying this times the other, this times other, like that. And you'll be able to get your what? Your respective total EV there. And definitely you would compare between the 64,800 with the 54,000, okay? And your comment will be, they should accept information if information is actually what? If information is actually, when you get the difference, which is the 10,800. So information should not cost more than that value, okay? The 10,800, okay? Yeah. So I think what I'm going to do, let me try to extract these notes and share with you so you can get some time and go through. I know we went through very fast, but because we just need to make sure we manage time. But when you go through, and I would encourage you to go through fast, it will help you to be able to conceptualize and even get more information about this, okay? Yeah, so that is it, unless, do we have any question? If we don't have any question, then we can end here, okay?
Yeah, there's a question.
Okay, what's the question?
Yeah, this is Henry speaking. Some of us were registered for October sitting, and so there's possibility that that you are going to sit for exams. Is there any catch-up plan way forward that we might, because we seem to be, not close to the end of the syllabus yet, but is there a way forward?
Okay, that is Henry. I don't know, even is at team Barbara and Thembo, did you also register for October?
Yes, I did register for October, sir.
Okay, and what about Barbara and Thembo?
Yes, I also registered for October.
Okay. Okay, that given that, what we shall basically do, let me try to look through my week. I don't know.
Also, Tembo, I also registered for
October. Okay.
Yes.
Now I want to find out how, because some of the catch-ups we may need to do basically, by the way, these might be early mornings catch-up, like early morning classes, okay? Because the evenings I already have some programs on them. So we may choose to do some programs during the mornings. And by morning, I mean from, because we want 2 hours, okay? I know you guys go at work. I don't know what time you go at work, you start your work. I know some of you may move, but we may try to do maybe 6 to 7 class. I don't know if that is possible. Not even 6, but maybe try to do maybe 5 to 8. Would that be possible? A 5 to 8 class? Can you be ready for class at 5?
You are meaning 5 at what? 5 in the morning or 5?
In the morning, in the morning, in the morning.
In the morning, 5 in the morning. To me, it's okay. As Tembo, it's okay, but I don't know the rest.
Okay, for me, I think right now, our time is not on our side, and if we are to catch up and make sure we sit and get something out of it, we just need to sacrifice this time.
Okay.
Me, if 5 is okay. Me, whatever it is, I'm ready to sacrifice because I really don't want to to get the worst.
Okay. It's that is okay. So we can try to balance through, and if you fail to join in a class, then you can try to see, maybe follow through the recording. But one of the things that I would encourage you now is, in addition to these catch-up classes that we want to do, okay, make sure that whatever you have, okay, you at least understand it, okay, and that means that you put in extra effort also on your own personally to go through what we have studied, and also relate those to also look at how questions are as well. Okay, so from my side, let me try my best to see how I can create my programs and see how I can create also some catch-ups for you. Okay, but I would also ask you that for whatever we've studied, okay, because of our program, and this is an online program, we have only, let's say, 2 hours a day. So we want to make sure that we at least utilizing what we've studied and trying to find out maybe more of that. Okay, so let me work on my side, and then I'll try to communicate. If today's Saturday, so Sunday tomorrow, okay, Sunday tomorrow may not be practical, but we may start like on Monday. Okay, we may start on Monday in the morning. Then we can at least do some hours, and then, because usually in the evenings I usually have some classes, okay, as well. And I'm going to also, because I have 2 papers that I teach, so I want to also create some other catch-up lessons as well for those other students as well. But for the MDC class, I'll basically do that. Alternatively, I can also do maybe a class during the day and maybe share with you a recording as well. Let me see what really works out, okay? Given that I actually had planned to ask you about your registration. So let's see how we can push this through, okay? Yeah, I think that is what I can say for now.
Okay, thank you, sir. Now, there are notes. I was trying to compile the notes since we started.
Yeah.
And there are notes about relevant costs and short-term decisions. So somewhere, those notes of relevant costs, I was not seeing them on our discussion group, on our group. So I would pray that if you can also forward us those notes, so that
of relevant costing.
Yes, because from a certain topic, I went on to short-term decision. So the connection, I was failing the connection because I was missing the other notes.
For relevant costing, I actually shared notes traced. I shared one version and then another version. Now we only followed through one version. So you may try to find the other version as well, which matches.
Okay.
You get it? Yeah, but I can reshare that, those that we went through. The others I just shared with you to just look at alternatively. You get it?
Okay. Thank you, sir.
It's okay. Let's see how we can push through, but make sure that you play your part as well. So you put in extra time to, I don't know what other papers you're preparing for. Do you all have only MDC or you have other papers?
For me,
Personally, I have
prepared for MDC.
Okay.
Personally, I have MDC and paper 15. So I have 2 papers.
Oh, okay. You try to balance your time based on your on what you have on your plate and see how you can strategize within these remaining times. Yeah, but I'll be reaching out on the group. Let me look into my schedule, then we'll share with you that. But just take our first class will be there on Monday in the morning. Okay.
Thank you, sir.
Okay. All right. All the best, guys.